Have you ever wondered about the downsides of Roth IRA? It's a question worth asking, considering the popularity of Roth individual retirement accounts. These retirement savings vehicles are often praised for their tax advantages, but as with any financial tool, it's crucial to balance the scales and consider the flip side. Roth IRAs have been widely adopted across the United States, and for good reason. They offer a unique blend of benefits, from tax-free growth to tax-free withdrawals in retirement. But, like any rose, they also have their thorns. From income limits and complex backdoor strategies to the absence of upfront tax deductions and strict withdrawal rules, Roth IRAs come with their own set of drawbacks. It's these less discussed aspects that we aim to uncover today. In this video, we'll delve into the disadvantages of Roth IRA, shedding light on aspects that might not be as rosy as they seem. One notable drawback of Roth IRA is the income limits imposed on contributors. This is a significant consideration for anyone evaluating the viability of a Roth IRA as part of their retirement planning strategy. Roth IRAs are designed to provide a tax-advantaged way to save for retirement. But not everyone can take full advantage of this financial tool. The Internal Revenue Service, or IRS, sets income limits that dictate who can contribute to a Roth IRA and how much they can contribute. These income limits are based on your Modified Adjusted Gross Income, or MAGI, and your tax filing status. For single filers, if your MAGI is less than $125,000 in 2023, you can contribute the full amount, which is $6,000 or $7,000 if you're 50 years or older. As your income increases, the amount you can contribute decreases. Once your income reaches $144,000, you're no longer eligible to contribute to a Roth IRA. For joint filers, the full contribution limit applies if your combined MAGI is less than $198,000. The contribution amount phases out as your income increases, and it becomes zero when your income hits $214,000. So, high earners may find themselves excluded from the benefits of a Roth IRA. This is a significant disadvantage, particularly for those who are keen to leverage the tax-free withdrawals that Roth IRAs offer in retirement. While there are workarounds like the Backdoor Roth IRA, they involve complex processes and potential tax consequences which may not appeal to everyone. Remember, financial planning is not a one-size-fits-all. It's essential to consider your income, your retirement goals, and your tax situation when deciding if a Roth IRA is right for you. This limitation can be a barrier for those aiming to take advantage of the tax-free withdrawals in retirement. But don't let this discourage you. There are many other retirement savings options available, each with its own set of advantages and disadvantages. It's all about finding the right fit for your financial situation and retirement goals. The concept of a backdoor Roth IRA has gained traction among individuals who exceed the income limits for direct contributions. You may be wondering, what exactly is a backdoor Roth IRA? Well, it's a strategy that allows high-income earners to enjoy the benefits of a Roth IRA, even if they don't meet the income requirements. Picture a traditional doorway, blocked by a velvet rope that only allows certain guests to enter. That's your traditional Roth IRA with its income restrictions. But then, there's a side entrance, a back door if you will, that's open to those who are otherwise barred from entry. That's your backdoor Roth IRA. This workaround involves making non-deductible contributions to a traditional IRA first. From there, the funds are then converted into a Roth IRA. Sounds simple, right? But, like a secret handshake or a hidden entrance, this strategy has its own complexities. Firstly, you must understand that the traditional IRA has its own set of rules. For instance, contributions to a traditional IRA are tax-deductible, but withdrawals during retirement are taxed. This is the opposite of a Roth IRA where contributions are taxed, but withdrawals during retirement are tax-free. The catch here is the conversion process from a traditional IRA to a Roth IRA. This conversion is considered a taxable event. This means that any pre-tax contributions and all earnings in your traditional IRA will be taxed at your ordinary income tax rate in the year you convert. Now remember, the whole point of the backdoor Roth IRA is to sidestep income limits. But if you're not careful with the conversion process, you could end up with an unexpected tax bill, negating the very benefits you were aiming for. This maneuver can be intricate and may result in tax consequences, making the backdoor Roth IRA less appealing for those seeking simplicity in their retirement planning. Unlike traditional IRAs, Roth IRAs do not offer an upfront tax deduction for contributions. This is one of the key distinctions that sets Roth IRAs apart from their traditional counterparts. It's important to understand this difference as it can significantly impact your financial strategy. In a traditional IRA, your contributions are typically tax deductible in the year they are made. This means that if you contribute to a traditional IRA, you can often deduct that amount from your taxable income when you file your taxes. This immediate tax advantage can be quite appealing, especially for those in higher tax brackets. Now let's contrast this with Roth IRAs. With a Roth IRA, your contributions are made with after-tax dollars. This means you don't get a tax deduction for your contributions in the year they are made. However, the trade-off is that your withdrawals in retirement are tax-free, assuming you meet certain conditions. While this trade-off can be beneficial in the long run, it does mean that you won't see an immediate reduction in your tax bill when you contribute to a Roth IRA. This lack of immediate tax relief might not be a major concern for those focused on the long-term benefits of tax-free withdrawals. However, it can be a significant drawback for individuals looking to reduce their current taxable income. Consider, for instance, someone in a high tax bracket who's trying to lessen their current tax burden. For them, the immediate tax deduction offered by a traditional IRA might be more valuable than tax-free withdrawals in the future. After all, a dollar saved today is worth more than a dollar saved tomorrow, thanks to the time value of money. Additionally, the absence of an immediate tax benefit can make Roth IRAs less appealing for those who are uncertain about their future tax situation. If you anticipate being in a lower tax bracket in retirement, the upfront tax deduction provided by a traditional IRA might be more beneficial than tax-free withdrawals later on. In conclusion, the absence of an immediate tax benefit can make Roth IRA less attractive for those who prioritize short-term tax relief over long-term gains. It's crucial to consider your current and future tax situation when choosing between a Roth and traditional IRA. Remember, what might seem like a disadvantage now could turn out to be an advantage in the long run, and vice versa. Roth IRA contributions can be withdrawn at any time without penalties. However, the earnings on these contributions may be subject to taxes and penalties if withdrawn before the age of 59 and a half. This is one of the key rules that govern Roth IRA withdrawals, and it's a double-edged sword. Let's take a closer look at how this works. If you're under the age of 59 and a half, and you've contributed, let's say $10,000 to your Roth IRA, you can withdraw that $10,000 at any time for any reason, without incurring taxes or penalties. That's because you've already paid taxes on that money when you earned it. However, if your $10,000 has grown to $15,000 thanks to the magic of compound interest, and you decide to withdraw the full amount, that extra $5,000, the earnings on your contributions, may be subject to taxes and a 10% early withdrawal penalty. There are exceptions to this rule, for things like first-time home purchases or qualified education expenses, but in general, it's best to think of your Roth IRA as a long-term investment, and the earnings on your contributions as off-limits until retirement. Once you reach the age of 59 and a half, the rules change. At this point, you can withdraw both your contributions and earnings tax and penalty-free, as long as you've held the account for at least 5 years. This is known as the 5-year rule. But here's where it gets tricky. Even if you've reached the magic age of 59 and a half, if you haven't held the account for at least 5 years, the earnings portion of your withdrawal may still be subject to taxes. This waiting period may be a drawback for those needing immediate access to their funds in retirement. Despite these disadvantages, Roth IRA offers significant advantages. It's a financial tool that allows your contributions to grow tax-free, an advantage that cannot be overstated. Imagine your hard-earned money multiplying over the years, and when retirement beckons, you can make qualified withdrawals without worrying about taxes. Now that's a sweet deal. Plus, Roth IRAs have no required minimum distribution during your lifetime. This means you have the flexibility to manage your retirement income based on your needs, not a dictated schedule. However, it's important to remember that every financial decision should be made after careful consideration. The Roth IRA, while appealing, has its own set of drawbacks. From income limits to complex backdoor contributions and lack of immediate tax benefits, these factors need to be weighed against the potential benefits. While Roth IRA is a powerful tool for retirement savings, it's essential to be aware of its limitations.